Good morning and welcome to RIA Advisors Candid Coffee. Thank you for joining us this Saturday morning. I'm Danny Ratliff with Richard Rosso. We're going to talk turkey today. We're taking it back a little bit old school. No slides, no preconceived agenda from, we do have a lot of questions, but we're just going to take this kind of office hours. So please, if you have questions, ask them. Go to the Q&A. We're going to be monitoring, checking in. We do have quite a bit that we can get through today. We're going to try to keep this right at an hour. We are, first and foremost, keep in mind, we are Clarity Financial, doing business as RIA Advisors. We are a registered investment advisor with the Securities and Exchange Commission. Please do not take any of this as gospel. Everybody's situation is different. What you may need may be different from your neighbor, from the next person. So, this is really just a candid talk here. So don't take any of this as a recommendation per se. But, Rich, let's jump in. I mean, it's been a tough August, September, October. Here we are, November. I mean, we looked at the odds. Lance talked about that, about a month ago. And, looking at the odds and going back to 1952 when markets have been negative in August and September. Historically, I think we've seen, three times, now number 4, that we had a negative October, but only one time we've had a negative fourth quarter. Is that something you think we can still kind of rely on with markets being oversold? We finally got a 5-day rally. This is nice. Do we see some legs in that?
It's the last 5 days have given you a lesson about you really cannot get all in or out of markets. Markets are there to confound you. That's what they do. I always remain humble in the face of markets and not, whatever my gut's telling me, and I always read both sides of a coin. I read the bullish and the bearish. And I try to make sure that there are rules, and we have rules. Obviously, if you read Lance's work, we follow a lot of rules. We also look at a very big macro view of things, long term, and try to also position portfolios where money will be going. Or once the narratives fade and the euphoria fades, what does it come back to? And we look at that. We look at cash flows. We look at demographics. We look at yields. We look at debt, household debt, and fiscal and government debt. We look at all of this to try to help you manage risk. And the reason we call this Talk Turkey this time around, because it's no fun. We have no fun in markets this year. It's been very frustrating.
Hold on, did that turkey talk?
Yeah. Yeah, you want to have some fun? Can't have it.
Man, were you gonna have some fun? Put in the oven?
There's no fun. Investing. People do not even realize, Danny, that the market hasn't, on the S&P 500, hasn't even recovered. In 2 years, we are still not where we were at the peak, right? It's been the magnificent 7 that have driven the stock market. If you take those out, you're negative. Bonds haven't worked. Cash works. But again, people look at these yields, at least the more astute people look at these yields and go, wow, this is great. And it's good to take advantage of those, right? We see people take advantage of 5% plus, but we also know, based on the macro, you're dating these yields. You're not marrying them. They're going away. They're going to go away. Our growth rates are going to slow. With all the massive debt we have, it's like running a track with 1,000 pounds on your back. This is a temporary situation. So we try to find good companies, good ETFs, and also shrink and expand the portfolio, right? We're not buy and hold, but we're not active traders either. I think that's where people get a little confused, because we are long-term in our range of looking at positions. But we also, if we look at technicals, to look at boundaries. So someone asked a question about sell rules. Stop losses. We don't have stop losses on each account per se, but what we do is we put bands around each position, and Lance looks at standard deviations above and below the position where we bought it. If it's 1 or 2 or 3 standard deviations above, we're watching that to see if we want to trim profits. If it's below, we actually might buy if the fundamentals haven't changed. If the fundamentals have changed, we're going to leave. If the fundamentals haven't changed, then we're going to get out. So, we try to blend fundamentals and technicals. But this year has been tough. And because, Danny, how many times do we tell, we tell everyone, because a lot of people are having a frustrating time, is no money manager, or nor should you, if you're managing this on your own. You're not going to place all your money in one sector in 7 stocks. You're going to have bonds. You're going to have some dividend stocks, right? You're going to manage the accounts, your own accounts, especially as well, to take into account more than a Google, more than a Microsoft, because there's risk involved with just owning one position. So that's where
that's right. It's interesting. I just visited with somebody that was saying, well, I feel like maybe we should just be more heavily invested in those areas, or just all in and something like that. And, it's like, well, in January, that's not what you wanted, right? And it's extremely difficult, right? This is such a challenging market. And, you're talking about the like kind of technicals and stop losses. We'll look at technicals, and we run a stop loss on each position. Now, it may be different in the sense that we don't just put a stop loss on the 50-day moving average or the 200-day moving average. We're going to have alerts. We're going to look at it. We're going to have a discussion surrounding it. And we want to look, is volume off? Is something funny here? Is this algorithmic trading? Everybody's been in a position where you've owned it at 90. You get stopped out at 80, right, on maybe a major moving average. And then it pops back up to 90. And you look around, you're like, what in the heck just happened? Right? So with all the advent of this technology, we've got to use technology to the best of our advantage, and also have that human touch. We want to say headline-driven news. Is it just the market? What has fundamentally changed? I think that was a really good point you just brought up, and understanding what goes into that. There are some companies, like you mentioned, we may look at that and say, man, we still have a very, very high conviction in this. We're going to give it a little bit more leeway here. And, we may even buy some more. Now, that doesn't happen often, but it does happen from time to time. And so I think that's a really good point that you just made. And it's frustrating. We were talking, John Penn and I were talking the other day, and said, this market environment is more frustrating than like 2008, right? 2008, everything was just hammered. And this year and last year, this year, market breadth is terrible. It's comprised of those handful of companies you just mentioned. Last year, everything was bad. Bonds have still been rough this year. But I think there's that opportunity there, right? I do see the glass half full in a lot of ways, in the sense of what the opportunity may be and the types of stocks that it can be in.
I agree. I mean, listen, you have to have the ability. Danny and I were just talking about Berkshire Hathaway before the call, and he's having a really good year, and he's got a lot of money in cash, because it's one thing he's waiting for. He's got over 157 billion in cash now. He's waiting for blood in the streets. He's waiting for us to sell as investors so he can buy, right? So Lance looks at things like he did an interview, really good interview with Morningstar, Market Watch, and it's on Morningstar.com today. And we own some certain stocks that get beat up, but fundamentally they look amazing, and we will add money to them. CVS, Raytheon. So sometimes people don't realize, they think we're all momentum traders. We're not. We look at value for part of the portfolio, momentum for the other part. So we do own the Googles and the Microsofts and all that, but we do want to own value. There has never been 3 years of negative returns for bonds. Well, you actually have to go back to when I was a little boy in 1787. Okay. But so Lance is looking at longer duration treasuries, and a lot of institutional smart money is looking at that, where retail investors, individual investors like us, are really sticking in the short end, because that's where they're getting 5%. But astute investors are looking at on the longer end of the curve. And that's been a painful place to be. Right. So, and it doesn't help that bonds and stocks are moving together, right? Usually when stocks go up, you want bonds to sort of hold, and the opposite. And that has not been, right? So thanks for calling me Russ. Who changed my name? That's what Lance used to call me. Lance got on the call with me yesterday. He goes, when was the last time I called you Russ? I said, like a couple of weeks ago. So
Rob, you listened to the show yesterday. Thank you.
Yeah. So this year, the reason why we're calling this Talking Turkey is pile on the turkey. It's been a pain. It's been terrible. I mean, I think, like, I agree with you. This is one of the worst years I've experienced in 32 years, only because at least in 2008 and 9, I knew we were going in one direction. Now we're all over the place. The little birdie flies into the window. Oh, we'll invest in that. And then the little birdie leaves. And then the little birdie comes in. Oh, let's go there. And this has been the most reactive, guttural market, primal, tribal kind of thing I've seen. Um, so it's very, very tough for an individual investor to make sense of it. We try to add rules and balance. So when you talked about the moving averages and stuff, I think the question might be, because I get it a lot, is we don't put stop losses on each. You don't go into your account and see a stop loss. We have amazing technology. We do everything in house. We track everything. We track it every day. We know how the portfolios perform versus the S&P or whatever other index. We know. So we also watch each position very carefully. But not only that, we're looking for new positions that are popping up. This is all proprietary. So we have these stock kind of components. We just don't. You don't go into your account and say, "Oh, look, I got a stop loss under XLE or something like that." It's all done in house, and then we have the technology to place the trades. So a little bit of how the sausage is made. Not that many people care. The most important thing, Danny, for most investors to do is to really know their allocation, know how much their risk attitude is, know that you have to have patience as investors and look at 5 to 7 year cycles for the most part. When you're buying something, and listen, sometimes we'll buy something that doesn't work, we'll get out. We bought Lennar homes. I'm a big fan of the home builders because that's where the money is going, because the secondary market's dead. But there have been reasonable reports to show with these mortgage rates that the whole housing market's going to be in pretty bad shape for a while. So we moved away from it. So there are times we're not perfect. We own up to it, make a mistake, we'll get out. That's
the story behind that was good too. I mean, and that was a trade, for instance. That was not one that we felt like or viewed as a long-term position. We have a handful of other positions that we view more as trades where, fundamentals may look okay, but technicals and kind of sentiment behind it may look really good. And Lennar, or even any home builder for that matter, we saw these guys giving much lower interest rates, right? You got to think about their whole sales process. And this is a good example, Rich. I think, you look at what's going on with home builders, right? How long does it take for them to attain the land, the permits, build the infrastructure, build the home? And so they're very incentivized to get rid of this inventory. So they were at the time giving much lower mortgages. Now, when you read between the lines, you start talking to people in that industry or people who actually run those businesses, they would tell you, well, we were giving 5.5% for 1 year versus the 8% mortgage that somebody could go get. We could go get the smaller things. So I think that is a really, the sentiment behind that is that if you wanted to get into a home, that's where a lot of people are going. Now, they just came out with new numbers for mortgages. Mortgages were down 22% year over year. I think that's going to continue to climb. We're looking at old data too. But ARMs have popped up, right? Because that's the only way people can afford it. If you have to move, what are you doing? You're doing it on an adjustable rate mortgage because you feel like rates will hopefully inevitably fall. And then you can turn around and refinance at a lower rate.
But here's where you have regret bias. So we sell the stock, right? The stock hit a low of around 102 roughly. And in the last few days, it's almost 120.
Oh, man, yeah.
The bigger lesson is just if you're going to get all out of the market because you feel bad about something, your gains come in these very truncated kind of positions. They come in these very seasonal chunks. You got to be real careful to always hold some money in equities that you like or an allocation. It may only be 10%. I'm not giving you an idea of like you have to be all in stock. I personally am all in stocks because I love individual stocks. I've been investing in them since I'm 13 years old. I study these companies. The gyrations day to day don't bother me. But most investors look from week to week, day to day. I don't even know what the definition of long term is. We try to help you understand is that you should do a plan. Figure out what your goal or rate of return needs to be and try to meet it or exceed it over time. And that gets you focusing on your goals, your life versus the market, because you're going to make a bad decision. You just are. With all the bad news out there, listen, I'm surprised the market's holding up as well as it is. There's a lot of bad news out there. Okay, there's a lot of negativity out there. And that is absolutely just when the market does better. It's so counterintuitive to our gut. I always tell everyone, trust your gut. I tell my daughter that, trust your gut. Trust your gut. I'd never do that in the market because your gut's, whatever your gut's telling you, you got to do the opposite. It's just its own little animal that you got to go out there and prowl, and you're in this terrain that's really unfamiliar to you. So you asked a question and we didn't even get to the answer. Yeah, I do think that this is your seasonally in a good time for stocks. And with the Fed looking like they're going to hold off. Yeah. What I didn't expect and what you see is look at the move, Danny, in 5 days. I mean, this has to cool off. This is not healthy, by the way. These kinds of moves that are so dramatic in nature are not healthy. It's a sign of an unhealthy market. You should see gradual movement up. So what you should see is some movement up. You'll get these, like this Lennar thing, just to use an example, is a parabolic move. That's not sustainable. It's not sustainable. So that's going to drop back down to a level that, and that's where your moving averages come into play and so forth.
Yeah, and so,
as an individual investor,
we're getting a lot of,
Danny, it's tough, right? As an individual investor, it's tough.
Well, it's tough.
Yeah.
I visited with somebody yesterday and said, Danny, I mean, there's just so much information. I don't even know, and it's, they have a small trading account. They trade on the side. And they said, I said, what are you doing? What are your parameters on your discipline on buying a stock? What do you do? And it was really sentiment is what we found. And I didn't even realize that. I mean, because, there's so much information that's out there and we're bombarded by it. Good, bad, ugly. We talked about this, how, bad news sales. Lance wrote an article, I think Tuesday, maybe, that actually showed a lot of the headlines. And they're just so bombastic typically. And we talk about taking things with a grain of salt. We have to remember, follow the bouncing ball. And look, there's a lot of good things and good companies that do provide a lot of solid information. We always need to figure out, what is somebody selling? Are they selling an ad? Number one, if they're selling an ad, it's typically always going to be extremely negative. You look at the news, you turn on the local news anywhere you are, I don't care where you are in the country, negative news sales. Your girlfriend's in the news. My wife used to be in television. They will tell you that, it is a lot of negative stuff, unfortunately. And that is the problem that with a lot of these things is that we can get so far on one side of it and not listen to the other side of the coin to understand why. What does this really mean? What does this impact? How does this impact my portfolio, investments longer term, and even in the short term? And because if we listen to half this stuff, you'd be into the market, you'd be out of the market, in the market, out of the market. It'd drive you nuts.
But Danny, you just brought up a good point. I don't think it's bad. I think it's good for investors to have, and I'm the worst for, I don't want to talk about mental accounting because money's fungible, right? You got to look at money in a big circle. But if you wanted to take a certain amount of money and you put it aside to trade, what I think it does for you is, one, helps you understand your own self, what kind of research you're doing, your emotional on. So, I think it's a lesson. If you lose it all, you lose it all. But think of it as an investment in your own knowledge to buy certain companies and do some kind of homework. And that's trading account, right? That's your chocolate. And then you have your portfolio, which is longer term rules based on academic study, based on what your financial plan needs to be. That's the serious stuff. It's okay to do this other stuff. I think there's a positive to that, because also people get to appreciate, we do too, when they do that. So it's a good lesson for people who want to do it. But we also want to help you on the talking turkey thing, is to understand that part of it's just like when you eat turkey, I am like a big Thanksgiving dude. I don't know about you, but turkey, I love turkey and all that other stuff, right? I mean, that's one of my favorite meals ever, right? Don't tell my grandmother about Christmas Eve dinner. I like that, but I don't like the octopus and all that stuff looking at me. So, the fish and all that. And this turkey's going to have its head taken off for. He's out of here. So you got to look at a bigger picture. Your Thanksgiving table is not just turkey; it's all these other things. Your money is so more multifaceted than your portfolio. It's like one layer of a 7-layer cake. You have to look at holistically decisions that you need to make that over time would actually have more impact than your overall portfolio performance. Your habits, how much debt you've taken on. Look how much debt, Danny, the government takes on. But look how households, the way they're spending right now, like there's no tomorrow. $1 trillion on revolving credit. Right? $1 trillion. I don't want anybody to hear it, Brent. It's cursing at everybody. So says nobody can hear the turkey. You can see the turkey. He smoked. All right. So
you're gonna have to ad lib for the turkey, though. Nobody can hear it.
I know, but they can see him. See,
or maybe not.
Maybe not see him. Yeah, let's not ad lib the turkey. So what I mean is that your money is so much more bigger decisions. How much debt your household takes on. The government's a terrible example, but people are spending like crazy. And we are seeing persistence in spending that confounds me even. We're seeing savings rates at lows for different generations that I haven't seen in a very long time. Part of it's inflation. I get that. Danny and I talk about inflation all the time. I do not think it's as transitory as everybody thinks it is. I've been saying that for years. We know it based on our insurance bills, our electric bills, our gas bills, our food bills. Prices do not go backwards. Rate of change can slow, but there's no one out there, Procter & Gamble, Kimberly-Clark, Mondelez, who makes Oreos. Lance is going to be very upset. There's going to be 2 less Oreos in his package. That's not going to change. What changes is the ability for them to raise prices. But the plateau is set. So that's, to me, longer term issue. And I do think the Fed has one more rate hike in them. And that's what Larry Summers says. I'm in the Larry Summers camp again. I was in the Larry Summers camp when he warned Biden about doing that second stimulus package that would have absolutely created inflation. So I said, this guy is absolutely correct. I remember that article in the Financial Times. I saved it. I absolutely believe when he said yesterday is don't count the Fed out to think that they don't, because I don't know, Danny, we're on this spending binge. Something changed during the pandemic with one of the worst decisions we ever made, right? Was actually locking people up for 2 years. We had people saving money, and I thought, oh my gosh, you know what's going to happen? People learned a lesson. They're going to save more now. No, it went the total opposite way.
Yeah.
Jobs are persistent because people still need work. Companies still need workers. People are spending. This is very stubborn to break. There's a level of inflation here. If you look at the Atlanta Fed, there's a level of inflation here that's very tough to break to get to the Fed target. So what are you showing here?
Well, this is actually an old chart back from March, but you're talking about kind of credit in general. This looks back to credit card debt and then really just consumer debt in general. This is a chart Lance had. This is going back to 08, 09, and you can see here where we are. So higher inflation, higher interest rates is really impacting the consumer. And that's going to become, at some point, here's the problem. At some point, especially with higher rates, and I'm not saying that there's potential. They keep leaving the potential for an additional hike there because they may need it. And this,
I think they're going to use one.
This is showing they're going to run out of runway, though. At some point, the consumer will, corporations will,
absolutely,
the government will, which is why. So we had a lot of questions on bonds, a ton of questions on bonds, and we, very rightfully so.
Yeah.
And one thing I think that to note this last week, the Treasury came out and issued they made a statement. They're going to issue a ton more bonds this last quarter and next quarter. Now, headline news is something you have to be cautious with too, because a lot of these bonds were maturing. Net, they're issuing more bonds, but not nearly as many as what the headlines would would suggest. But the big takeaway from what they're doing, though, they're not issuing long-term bonds. They're issuing short-term bonds at higher yields than what those long-term bonds are. Why would that be?
Mm-hmm.
Because their belief is that they're going to see lower interest rates in the future. They don't want to lock in these higher yields for longer. They'll pay you a little more short-term and then saying, okay, yields are going to decline. We're going to go then and refinance that debt later on in the future. So the Fed, the Treasury is telling you something. And if you don't think that Janet Yellen and Jerome Powell are talking on a regular basis, I mean, they're lockstep, I would think, in a lot of ways.
Yeah, that's some brain trust.
Well, yeah, I mean, not saying that's a good thing per se.
But to your point, it's right.
You had Janet Yellen running the Fed since 2014.
Yeah, she's been making mistakes since then.
Correct.
The thing is, to your point, longer term rates are a function of economic growth and inflation. If you think economic growth is going to be what it was in the 70s and the 80s, which we had great population boom, we had household debt to GDP at 30%. I can't remember where what I was talking about, I think government debt to GDP was like 30%. So, this can't last. We're not in that situation again. Take a look at demographics across the globe. Nobody's having babies. Household formation is one of the lowest levels I've ever seen. More households living together than ever before since World War II. If you look at Pew Research, this doesn't portend to higher economic growth. People forget the work of Ken Rogoff, and This Time is Different, and government debt and what it does to economics. I wish more people would go back to reading it. Reinhardt and Rogoff's greatest book, This Time It's Different, and looked at debt across every country. The book came out about 10 years ago. It's still one of the best books ever written, and studies of higher debt, lower growth, throw in demographics. This is not some new growth paradigm that we're seeing in the U.S. economy. This is a cyclical kind of situation and a long-term trend that we have to be aware of. So, Danny, what do we do? Like, as individual investors, besides the portfolio, there are certain things, right? What can we control? Yeah, you're right. Nobody can afford to have babies. Oh my gosh. I mean, listen, my girlfriend's got the best little kids in the world, and I'd do anything for them. I just paid for us to go to Santa's Wonderland in December. 5 tickets. I just want to make sure we don't have to stay online and all that. So Santa's Wonderland is a place out near College Station, Texas, if you don't know. And it's been one of the campiest, most inexpensive kind of fun things. I did it with my daughter when she was little.
Whoa. You said inexpensive?
Well,
Santa's Wonderland in one?
It was.
It was.
So I'm just trying to.
It's so expensive now. I can only afford to drive by it and have the kids look out the window and wave.
So I want to help you understand, and that's what it's cost about having kids. This was a really campy kind of fun family kind of low cost kind of thing. Tickets and everything. That doesn't even include stuff you buy when you're there. $600. And I say to myself, how the heck can families afford to do anything? So yeah, younger people are going, why do I have kids? I think I'm going to have grandcats. This is where I'm going. Because having children, having pets, everything is more expensive. You're wiping out the middle class, right? Go to Disney, for example. My gosh, who goes? Look how expensive it is. You have priced everything out of. So people go, listen, children, I mean, even if I want to have one, I'm going to wait longer. I want to get my career set. I need to make more money because they know financially what it's going to be. So, this all leads to the long end of the yield curve. The Fed doesn't affect that. So, if I was a smart contrarian investor, I wouldn't, and I'm not, this is not a recommendation. I would be heavy in long duration bonds, and I wouldn't have one tech stock in my portfolio right now, except maybe Microsoft, because of the run-ups, because of the probabilities of where we're going. Because I don't need to worry about it from one year to the next. I'm looking 5, 7, 10 years down the road.
Yeah, but you're talking extremely long. You're not talking about the short-term gyrations, the next 3, 6 months, 1 year. You're talking about if you could set it and forget it, live your life, not worry about one thing, that's what you would do. And that's the problem, I think, for most investors, that we can't. Accessibility to information
No, we
is right
can't do
there
it.
at our fingertips.
Do it, but we own some
I
long
mean,
duration bonds, and Lance in his own
correct.
is owning TLT and long duration. But I would buy 10, 20-year
Well, an
bonds.
individual bond, yeah.
In my IRA, if I were young, if I say I was your age, I'd be like owning longer duration zeros, right? Knowing I probably won't hold them to maturity. But even if I do, I'm locking in these rates that I know are not going to stay. The other thing about long-term rates, and Lance is always, because he's better at this than me. You ever lend money to a relative, and they always paid you back, like very reliable John, reliable John.
I think you usually look at that as a gift, right?
You do, but I'm saying, let's make an example. You always lend money to your cousin Lenny, and Lenny always pays you back. Lenny's always doing, but then something weird is going on with Lenny. Like, he spends a lot. He's a little off his game, and he comes to you for money, and you usually charge him interest. And you go, this time I think I'm going to charge you a little more because I'm not really sure of you right now. I think that's how bond buyers are looking at the United States based on how we are spending, how we are dysfunctional, and going, they're usually really pretty dependable, but I think I need a little bit more premium to invest. Because with all the geopolitical risk going on, I really thought yields would drop on the longer end a little bit more than they have.
Yeah, no, that's true. And so a really good question.
Let's talk about questions, because we're at
So
8:30 already. What's some of the questions we got?
So Lance had mentioned that we need to be concerned about when the yield curve un-inverts for bonds. And that's when we need to be cautious with stocks. And so kind of what's the game plan there? And at that point, I think I could lay out a game plan that you and I would agree on, because we talk about this daily. But I think that we have to be cautious with that, because the narrative can change very quickly. The dynamics, everything surrounding it can change. But if I laid out a perfect game plan, maybe we get this run up through the end of the year. You reevaluate. You see the yield curve beginning to un-invert slowly, albeit. And at that point, you start to reevaluate, and you start to look and say, okay, where do we start to trim? Let's start reducing exposure, moving into 2024, watching the economic landscape, what's going on. And at that point, you start to reallocate some resources in other directions. But we've got to be cautious with that, because these things are moving so quickly. The Fed is, the Fed's message has been pretty consistent over the last, 3 months, last 2 to 3 meetings, where we've paused. We're going to wait and see. We're going to leave a rate hike in our back pocket. We have seen China has stopped hiking. They've claimed they've hit their terminal rate. You've got Bank of England, European Central Bank. We've got areas of the economy or the world that are now dipped into a recession. Higher rates certainly have had an impact. Even Jerome Powell's noted that he does realize the time it takes and the lag of the data. And so I do think that that's good. I mean, I know we give Jerome Powell a really tough time, but and it's easy, right? We can be that armchair quarterback all day long. He's dealing with information that historically is behind him, that's likely to be revised. And I think it's very difficult to look at that forward guidance, because he can think one thing, and then things he can't control happen, right? You have fiscal policy that occurs. You have things that pop out, and he's like, whoa, okay, well, this changes things a little bit. And that's why I think you went from transitory, not hiking, to the fastest rate hiking campaign we've seen in our lifetime. And it could reverse that same way, but it may take a little longer, because he's going to have to keep as many arrows in his quiver as possible. He's not just going to go out and just say, hey, guys, we're going to start decreasing rates as quick as we can, unless there's economic devastation, which we don't want that either.
And he's dealing with a lot of mistakes from his predecessor. Let's face it. Janet Yellen had multiple periods, we've called her out, where she had the ability to raise rates over time, and she didn't do it. We had a healthy economy. We had no financial crisis, but they were still doing the same thing. Do you feel like you are? Yeah. Because if I look at a lot of the metrics, and the market's been telling you this outside of the tech stocks, you're in a quagmire of kind. I mean, at least with a recession, I know there's a contraction. I can see it. You're in some sort of stagflation light kind of period. So where some economic growth is picking up, I think the labor market's been the most confounding thing that's driven this. We finally started to see average hourly earnings drop off a bit. Actually, if you look at every quintile, as far as wages, highest to lowest, real incomes are down. That's adjusted for inflation. Real income is down in the face of higher prices. So, yeah, I feel recessed. I'm feeling a lot recessed, right? But this is a slow rolling train to recession, right? This is what we're seeing. But the most important thing is one, you got to make sure you have good. We're noticing that savings coffers at the lowest levels we've seen in a long time. You've got to have your emergency savings, right? That's one of our basic tenets, right? We call it the financial vulnerability cushion. 6 months for stuff that breaks down, 6 months in case you break down, which means you lose your job, somebody in your family gets ill. So that's a year. And I'm getting sort of paid for it now, even though it's not, based on food inflation, it's not really beating the rate of inflation, but that's not what it's there for. It's there for an emergency. It's there for liquidity. Liquidity is king when it comes down to contractions, right? So that's a really good basic. If you, saving more is a thing, right? We started to see a boost in, and we always think of Roth versus pre-tax. But I think we've seen an increase in contributions, employee contributions for next year. Those came out, right, Danny?
Yep. So talk about that liquidity is king aspect and what that looks like and what that means. I mean, and why you feel that way. Because I think it's twofold, right?
Yeah. Living smaller is also adds to your financial liquidity, right? If people want to go out and buy a home right now, I have a great 4-letter word. It doesn't start with F, it starts with W. Wait. Wait. Do you need to move? Do you need to do it? Don't do anything. Build up your cash coffers, live smaller. And that's a good way to. We talked about this right before the pandemic, remember? We had no idea what was coming.
Financial vulnerability cushion. Yeah.
If you're living
essentially
smaller right now,
saving more.
If you're living smaller right now and you're saving more money, you're watching your spending, yeah, it doesn't feel good because every time you go to the store, you go, ouch, and you wince, but you should be thankful, right? It's Thanksgiving, thankful that you have the ability to do it, where some people don't. So I think doing the opposite of what most Americans seem to be doing right now. Spending on credit cards at 27, 29% interest, doing all these smart things are better longer term impacts to your household than whether I buy CVS or Raytheon. I mean, these are big decisions. These are good decisions to make. I have a client, children want to go to college. I wrote in my book years ago, there's no reason why your child has to do 4 years of college. That was 2012. Start them in a community college. Then they can switch. I don't care. They want to go to a party school. I don't care if they want a fancy name, right? My daughter thankfully came to me, Danny, when time came to me and said, Dad, I think I'm going to go to Lone Star. I think I'm going to do that for 2 years to get my basics, but I could stay at home and I know what I want to do. And I was like, I think that 2 years, she loved it, right? She's at Emory right now for a PhD, but she did those 2 years. All her credits transferred over. She did those 2 years, and it cost, I think, maybe $6,000. for 2 years.
Yeah, that's amazing.
Teach your kids financial restraint. Teach them delayed gratification. It's so important for them going forward. So important. And if as advisors, we practice what we preach. Danny and I, we don't have a lot of debt, right? We manage things well. We live smaller. We don't drive fancy cars. We do. So we practice what we preach to you. I know how many advisors are like telling you to do this, do that, and then they get off in their Maserati and their Rolexes and stuff. It's ridiculous. What are you trying to tell me here, right?
Yep. Yeah.
You're in more debt than I am. So you're telling me what to do? Yeah, okay.
Yeah,
so
that's right.
What we're telling you is we practice this stuff. So those are things that you want to do in your own household. Stay healthy, eat right, stay mobile. I have clients yesterday, I talked to elderly clients. They walk a lot, to stay mobile. They do all these things to stay healthy, which equals wealthy. I mean, these are things that have nothing to do with portfolio. It's a terrible time to tell you to eat right around Thanksgiving. Like Brent decides that he's going on a diet right when Thanksgiving's coming, and then gives me a big bag of candy corn. But I parcel out my candy corn. I eat it, but I parcel it out. Like I don't eat it all in one sitting. I take some out, I have a little, I put the rest away. It's called discipline.
Yeah, a little self-control goes a long way. So going back to that question though, Rich, so, looking at that kind of twofold on why, we're talking about financial vulnerability cushion. So essentially what that is, we've been advocating for this for a while and saying, hey, times will get lean at some point, and here we are. And from a job perspective, it hasn't been nearly as bad as what many people have expected, but that can change, obviously. So the financial vulnerability cushion is essentially having additional emergency savings. So, right, you want to have your emergency savings at 6 to 12 months, depending on your household. If you've got a dual income household, if you're on a job that is maybe, commission based where your income fluctuates quite a bit more, you maybe want a little bit more, or even in a volatile sector. If you're a tenured professor, maybe you don't need as much, but those are things that, we want to look at. But then really it's about saving in addition to that. So what happens if your car breaks down, the washer and dryer go out, and you lose your job, right? Now we could be in trouble. So that's why we want to have a little bit of additional funds on the sideline in that aspect. Now, the other
and you can also write a country song. You can also, because you got that, my washer dryer broke, I lost my wife, I lost my job, but I have my financial vulnerability cushion.
That's right. And so the other aspect around this is that, we hear so much, and obviously we manage money much differently than most, in the sense that we're more of what you'd call a buy, hold, monitor, and sell. And so we reduce exposure, we increase exposure when the time is right, or hopefully right. And you're going to be rather nimble is the best way I can describe it. But we are not going to just say, hey, we're going to ride this whole thing out, stay fully allocated, time in the market, not timing the market. Because listen, if you're close to retirement, this could be a major issue. If you're taking distributions from your portfolio, you need these funds to live on, and you're just writing it down, it's going to become very difficult to get back to even. And we talk about the math of loss often. And so the other caveat is having some dry powder, so to speak. You mentioned Warren Buffett earlier when we started. So you can go buy things. And that doesn't mean that you have to be in pure cash. Cash is finally paying something. But, maybe cash alternatives, maybe having a strategy that allows you to reduce exposure at times so you can increase that cash exposure. So then later down the road, when things are truly on sale, you have the ability to go out and buy. And I think that's the other side of this, that, trying to think about what to do, how to do it, and then taking the emotion out of it is probably the most difficult thing.
Someone asked about strategic allocation. Sorry, I don't know, because so many questions coming in. I will tell you that there's nothing wrong with having some form of foundational asset allocation, but that really goes back to traditional tenets of asset allocation, and that's really a risk attitude, right? You might say that I'm going to have, percentages. First of all, I got to look at how much I want in fixed income versus stocks. Then I got to figure out how I'm going to slice within these stocks, right? Some people just own the S&P 500, the EFA, and the IWM, Russell small cap, for whatever percentage they feel comfortable. So I have clients that'll do strategic, and then the rest is in bond index. I mean, but and then maybe they have 3 to 5% in precious metals or commodities or something like that, right? And that's okay. If that's something that you want to do, you could do it in a very low cost manner, but you want to also look at it every year and say and rebalance it, because people don't look at it and say, even a strategic allocation, you have to rebalance it, because some area is going to get overweight, some area is going to get underweight, and you're going to want to shift it. We personally don't, if we don't want to own international, we don't own it. There's nothing in modern portfolio theory that says you always have to own international. You always have to own emerging markets bonds. You always have to do this.
But that's what most have been taught.
Those are compliance departments dictating that, not modern portfolio.
Yeah, but that's the way most major firms operate. They're going to say, hey, international, we want to hold 15% at all times. If we like it a lot, we'll add 3% to it to make it 18. If we don't like it, we'll reduce it to 12. But if we don't like something, we're just going to reduce it altogether. That's a whole. We don't have to be in every asset class. Now, there are some areas that we're going to keep, maybe on a longer type of theme to play out. Interest rates, the play on that is a good example. Where I think there's some significant opportunity there. But, catching a falling knife is difficult sometimes. And in this environment where we've had so many, you look at the data, say, okay, this makes perfect sense. And then boom, you get another stimulus package or the extension of a program or, more money thrown out in other ways. It's made it challenging in a lot of that aspect. So there's arguments to be made that you don't have to remain in every single asset class at all times. So international is a great example there.
Yeah, and there's no reason why that if you have, say, small amounts of money, or you're talking to your children about opening a Roth and doing that and saying, hey, you look at it strategically, knowing that they have 30, 40, 50, 60, they have years ahead of them, right, to weather out whatever storms are going to hit those particular asset classes. In retirement, or close to retirement, 10 years from retirement, it's a little different, right? You can't afford to take big losses. So, you want a strategic layer. We still have a foundational layer under what we do. We're not going to get all out of stocks. We'll shrink them, but we're never going to get all out, because what's going to happen. The Fed's going to run in on the white horse, and we don't like recession. The big secret is, which is not so secret, is we don't like recessions to happen. We don't allow the free market to do what it's supposed to do. We'll bail out everything. That's why stocks can sometimes be so obstinate, right? Because there's this, I talk to a lot of younger, Gen Z investors, and yeah, it's okay. Yeah, the government's going to just send me a check, or, Fed's going to take care of it. Frankly, that's what they know. And that's happened every time. I look like the old guy on the lawn telling them to get off. It's going to change. It doesn't. Sooner or later.
Well, and that's a sad thing. We used to teach personal responsibility, and people had to stand on their own 2 feet.
We used to.
And now you have a generation of people that just expect that the government is there to bail us out. Yep. That is not the purpose of the government. The purpose of the government is to provide infrastructure, security, which we do a poor job at both, probably in some ways.
Yeah, check the holes out in front of you. Yeah.
Yeah, that's a whole nother discussion.
Yeah, but and bailouts have costs.
That is a correct.
And they do.
It gets more and more expensive.
And that portends to lower growth and lower bond yields to bail us out.
So, Rich, what do you think about the U.S. dollar right now? I know that's a big headline-driven event or news. We saw a significant run in the U.S. dollar over the last several years. We are seeing it come down a bit. What are your thoughts there?
As soon as the Fed starts looking at lower rates, the dollar sort of falls back with it. But the dollar has been on a tear. Everybody's like, oh my gosh, the dollar is going to be going away. The dollar's done. And just dude, have you looked at the dollar? Yeah, what your dollar is buying is not going as far, but where am I going to put my money? I mean, listen, I understand to each other we look dysfunctional. I get that. But have you checked the rest of the world? What's that terrible analogy I use, the toilet analogy? All the countries are in the water. We're still on the rim. I mean, I think
that's a bad one.
We got a toe in the water now. But, but as the Fed looks to be more dovish, although I think that the market's overreacting to whatever dovish talk. That's my own opinion, that I think that this inflation is a lot more stubborn. So the dollar might, stick in its support right now, but money still comes into our dollar. Maybe in 40 years, it's no longer the currency. Maybe that's not it. Maybe there's some other great place for you to put your money. But for now, that's what it is.
Well, we are seeing more and more technology, more news driven around, other countries developing some type of, other type of means to pay. Or, like years ago, I can think back, Russia and China, you think about how much border they share. They were having to use the dollar as the middleman. They found a way to eliminate that so they could trade back and forth with their own currencies. But the dollar is still the more stable place to put funds versus any other place in the world. If you look at
go ahead and put your money with China and Russia.
Well, yeah, right. I mean, so you think about it, and then there's this big push on these countries, like Brazil, kind of the BRIC countries looking to start their own currency, South Africa. Who trusts a lot of these places? Do you trust these quote unquote dictators? Do you trust these guys that are, the way they run their country? Would you want to put money there? I don't know. I mean,
kind of rules.
I can't think of a long.
What kind of rules and laws do they have? I mean, not that we have. I mean, not that our rules and laws are getting a little more porous, but for the most part, we're still better, right? Where the heck am I going to put my money? And then people say, well, I'll put it all in gold. Well, I'm like, well, gold's not a medium of exchange. I mean, I have no problem with owning gold. I don't think there's anything wrong with people owning gold. I mean, you want to use it as a diversifier. You want to have coins or whatever to pass on. I don't think there's anything wrong with it. I just think you thinking that if the world's coming to an end, gold isn't it. You ever watch the Book of Eli? The medium of exchange were wet wipes because no one could get water. I mean, I don't know what the medium of exchange is going to be if the whole world comes to an end. I would think it'd be more food related because what am I going to do with the gold? Hit Danny over the head and steal his guns? What am I going to do? I mean, so I'm just saying that I don't think there's anything wrong with it. And gold generally will better perform when the Fed's a little bit more dovish. Gold will tend to do better. But even in the times of geopolitical risk, if I am worried about the geopolitical risk more than I have been in a long time, money should come into treasuries as a safe haven. Generally, that's how it's always worked. So,
it doesn't mean it can't change. It doesn't mean that there's other options out there. I mean, I think that we're going to evaluate every option that there is, but you've got to look at what do these governments want to do. They want to control money. And that's the United States as well. You look at the advent of talking about doing our own type of coin-based type of exchange. And we're moving towards that. I mean, I hear so many people say, well, a cashless society is terrible. And I don't disagree. I think having cash is nice, being able to do what you want with it, not being tracked. And we talked about what if you get in an environment where, they say, well, you spent too much money on gas this month. You're not going to be able to buy any more gas. Shoot, down here in Texas, we'd be in big trouble. Nothing's close. But those are always concerns and things that could happen. Now, what is the timing of something like this? Probably further out. Does that happen immediately? No. But these are always concerns. And I hear them from you guys often. But there's concerns with every currency. I think there's concerns with every country. Like Rich mentioned, we're still the best. I'll use a different analogy. We're the cleanest dirty shirt for the moment. But things change, and we have to be prepared to change with it. So we're not going to be so set in any one conviction.
Beaver nuggets would be a great medium of exchange.
Beaver nuggets?
They look
like you guys gold. Don't know what that is.
Yeah, those are.
Yeah, look up Buc-ee's. It's a massive gas station, kind of like a Walmart almost. I know Rich is not going to like that. I know you place Buc-ee's way above Walmart, right?
Yeah, I can't compare those two. I'll just keep my mouth shut. King Buc-ee's. So I think what you have to remember is you can control a lot of things. You can't control the portfolio. It's been a turkey of a year. Maybe over the next 2 months, although I do think this run is way overdone. You'll get a cooling off period. The biggest lesson I learned from this is you cannot be all out or all in the market. It doesn't work. Believe me, Danny and I have no agenda here. We're not trying to sell you anything. It doesn't work. It just doesn't. Okay. I have more people that are the best contrarian indicators. Last week, I have someone that I work with that said, yeah, I'm going to all CDs right now. I'm like, oh, the market's going to turn. I don't know when, but it's going to turn real soon. There you go. Best contrarian indicator I have. Don't go with your gut, man. It doesn't work.
Yeah, no, absolutely. Well, and you got to take this to heart too, that everybody's a little bit different. What works for you may not work for somebody else. Understanding markets in general.
The majority of people, once they get out, they don't go in. Can it work for other people? Sure. Can some people have money on the sidelines like Warren Buffett and buy when there's blood in the streets? But I will tell you how many times through 2009 that I tell people, it's time for you to go back in 2012. It's time to go back in. Nope, not doing it. It's going to get worse. It's going to get worse. Once you're in it, if you're in a bull market in the middle of it or a bear market and interview investors, most of the time they're going to be bullish or bearish. They're going to go with whatever is the mood at the time. That's recency bias. That's how we're made. That's how 99% of the people are going to work. January, you just brought it up, Danny. If you went and talked to someone about putting money in tech stocks in January, what kind of response did you get?
Oh, heck no.
Why would I do that? How about energy stocks the year before that? No.
Nobody wanted to touch it.
Warren Buffett, and I'm not saying we all are Warren Buffett. We can't be Warren Buffett, but take a little page from his book. It's hard to remove the emotional response, the primal response to save and hide. It's just called the lizard brain. There's a great book out there called Lizard Brain. Okay. It's about how you respond emotionally. We are not wired to invest. We're just not.
So Rich, what are your parting thoughts here? We've got a couple minutes here left.
Okay. I think you have to focus on things you can control. Lance is going to write some piece on regional bank stocks coming up. We do own PNC. They've had a big move here, but there's still a lot of, you got to look for the ones that have minimal commercial real estate exposure. But I will tell you, the whole office space area is in turmoil, right? Nobody knows how to work anymore. Nobody knows what to do with the downtowns. One of the PIMCO funds just unloaded a huge amount of real estate. This is an area of turmoil, how people are going to work. Are they going back to the office? Is it hybrid? Who the heck knows, right? So your regional banks have been beaten up, but there's going to be a plateau level where their growth is going to be stunted for a while. So you might have a nice little rebound rally here, but moving forward into growth, there's still a lot of headwinds ahead, right? Yeah, and the media does play, Ebert said, huge role. Yeah, clickbait, all that stuff, right, Danny? It's terrible.
Oh, humongous. It is. So a lot of moving parts, guys. We do really appreciate you joining us this morning. A lot of great information, great questions here. Really just intend to keep this kind of open dialogue like we did today. We'll be doing more and more of these. Keep, log into realinvestmentadvice.com, go to the events tab. We will announce when we do another one of these. We'll probably slow down here a little bit for the holiday season, ramp up 2024. We're going to have a lot of events, a lot of things to address these questions, some very specific lunch and learns based on topics that are important to you guys. Would you guys please take a survey at the end of this and let us know what you want to hear? What are the topics that are important to you? And if you'd like somebody from RIA to reach out to you, we'll be happy to do so. You can just fill out in that quick survey, ask somebody to reach out. Happy to have one of our advisors give you a call and, just give you some ideas, kind of share what we do, or, you just have some specific questions. We're always happy to answer. So thank you guys so much. Enjoy your weekend and happy holidays, Merry Christmas, and happy Thanksgiving. Let me get there first.
Happy Thanksgiving, everybody.
Thank y'all. Have a great weekend. We'll see y'all soon.